Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Dave Breazzano. He's the head of credit team at Polen Capital. Ed Goldstein, chief investment officer of Coller Secondaries. We have Brett Lauber, managing director at Northleaf, and Saba Ahmad, president of Turning Rock Partners. They join us to discuss the macro environment impact on private credit positioning and analyzing deals. It is great to have everyone with us, and let's just go around the horn real quick for a brief intro. Dave, starting with you, where do you sit within the private credit space?
So I'm responsible for the credit division at Polen Capital, and we focus on both public and private debt, below investment grade, bonds and loans. So we're agnostic to the type of instrument that we invest in.
And Ed?
I co-run our credit secondaries business at Coller. So unlike the other panelists here today, we are a provider of liquidity to investors in credit funds.
Right. And Brett?
Yeah, so Northleaf is a global investment firm focused on private equity, infrastructure, and credit. We've got 25 billion of assets. I focus on the credit team, where we manage around 6 billion of assets, specifically focused on sponsor-owned businesses and asset-based specialty finance.
And Saba?
So Turning Rock Partners, we are a women-owned and led investment firm based here in New York City. We focus on the non-sponsor-backed portion of the credit market. So we are working directly with founder-owned and led companies.
Right, and Saba, how would you characterize the current state of the private credit markets? I can tell you from a coverage perspective, this is the most that we've covered it, I would say, over the past 12 to 18 months. It's been one of the hotter topics.
So I think that it's a great time for the private credit markets. I think that the market has gone through an evolution probably over the last 15 to 18 years coming out of the global financial crisis. It used to be a very niche market. I'd say, back before the GFC, you'd primarily see private credit firms working with buyout private equity. So they were providing the leverage for those specific deals. Then after the GFC regulation came into play, what banks and investment banks formerly used to do, there was a gap from that. So I think players have stepped in, and you're starting to see areas on the larger deal side as well as getting into the middle market where there's a lot of firms playing in the space.
Yeah. And Brett, how does a large cap versus a middle market, how do they perform differently, or why is it a bifurcated market?
Yeah, so I mean, I think it's interesting. We've seen a lot of capital flow into private credit. As you mentioned, it's a hot area. And I think out of last year, like 40% of all capital raised went into these mega funds, right? So there's a lot of competition in that large cap market. And so it's becoming more bifurcated, really. You're seeing a lot of competition, a lot of asset gathering going on in that large cap market. And whereas the middle market remains very relationship oriented, better pricing, better terms. I think that dynamic has always existed. It's just a lot more, it's standing out a bit more in this moment in time.
Right. Why do you think that is, Ed?
Well, I think you're seeing more and more large cap funds competing with the syndicated loan markets, primarily to lend to large borrowers. So as you get to companies of 500 million of EBITDA, $1 billion of EBITDA, those borrowers they're accustomed to having more flexibility, better terms. And so you see the larger end of the private credit market really much more heavily competing with the buyers of traded loans. So not the banks, but things like CLOs or income funds. And so it's just moving the competition to really a different front for the larger cap funds.
Right. Do you think this is a trend that's here to stay, where we'll see continued growth as companies look for alternative forms of lending and capital raise?
Yeah, I think it's an interesting and trending dynamic. So today, with the amount of capital that's come into this space and a lot of the large asset gatherers moving up market, a company who wants to borrow money will engage a banker or whatever, and they'd look at three broad categories of opportunity to borrow money: public bond market, the leveraged loan market, or the private debt market. And wherever they get the best terms is where they're going to go. So the concern would be in the larger deals, it's effectively competing with other markets, and the yield premium that one would have expected historically is dissipating a bit. You sort of see a gap in the lower market, so you still have the yield premium, and the ability to get good covenants and things like that. So we see a trending opportunity to stay middle and small cap, and that's what our focus is.
What's the macro impact been on the private credit space?
Well, the macro, I mean, there's a lot of aspects to it, but with the significant increase in yields over the last couple of years, it's made credit more attractive, and so there's a focus on investors to seek out credit, and now the hot dot is private debt, and the lines are kind of blurry a little bit between the difference between private debt and syndicated debt. If you have 25 private debt investors in $1 billion deal, it's not much different than a lightly syndicated public deal as well. So, you know, with the attractiveness of credit with yields where they are today has caused a flood of money, and where there's money, investment bankers and borrowers are going to seek a way to tap that money.
And I think there's no doubt it's an attractive time to be in private credit. But it's interesting because the elevated interest rate environment right now has done a few things. The first is, you know, when a private equity firm is trying to make a leveraged buyout, they can't get the same magnitude of financing, right? So now their purchase multiple has to come down commensurately. And so you've had this buyer-seller impasse. The bid-ask spread has widened in terms of purchase price. So that's reduced M&A activity and extended duration. So for credit, that's great. I'll take longer duration in a high-yielding security. But what it's also done is it's really brought innovation to the market. So we're seeing continuation vehicles, NAV funds, structured equity, pref, PIK notes. Like, it's brought a lot of innovation to the private markets.
Yeah, and of course, if there's investor demand, they will deliver the product.
Exactly.
I mean, yeah.
No, but I think you also have to think about it for companies as well. So, you know, when you're in this market, rates are up, that's wonderful for investors, but then the companies themselves are then facing those elevated rates. So what is the investment manager doing to really understand the risks associated with those companies and allocate capital in the right way to protect an investor's capital?
So yeah, I mean, just to add to that, so as a private credit manager, right, there are attractive yields today if you pick the right companies, but you also may have some companies in your portfolio that maybe can't make their interest payments or have liquidity issues. So it's a balancing act, right? Because you want to, you know, you've heard the term golden age of private credit, right? So for the right borrowers, for the right covenants that you can get, in particular in the lower end of the market, it's super attractive. But you also want to make sure that you are you're still getting the right protections, or you're not putting companies at risk by lending money to them at, you know, spreads that are going to potentially put them at risk 1 or 2 years down the road if the Fed doesn't cut as quickly, right? Everyone said rates are going to be down by now. They haven't moved yet. So it's just something to bear in mind.
Well, let's talk about some of these deals for a moment here and how you analyze them. What are primary motivations for sellers in credit in the secondary space?
So, well, just to get to something that Brett was mentioning earlier, so slower prepayments, slower M&A means longer duration, right? So it's good as a credit manager if the credits are performing, you own them longer, you get the yield longer, it compounds the multiple in your fund. But for someone like us, we're providing liquidity to investors and funds. And so if you're a manager of a fund and you have loans that are performing with longer duration, the length of your fund will increase. So again, performance might be good, but if you're a limited partner in a fund and you expected that fund to liquidate sooner, you might say, well, actually, I need liquidity now. So I might, you know, I've had good performance to date, but I haven't gotten as much money out as I want to. So maybe I'll look to get liquidity so I can maybe reinvest in the manager's next fund or maybe redeploy into other asset classes. So as a provider of secondary liquidity, it's you know, this market, the secondary market benefits from longer duration for investors who may have seen good performance but just need to see more capital come back.
Right. Right. And so, Dave, when you're looking to analyze a deal, what specifically is attractive for you?
Yeah, the bottom line, I think, for all of us is we want that company to pay us back at maturity, or hopefully sooner. So that's what we're looking to determine. And so what we want to do is, you know, as debt investors, you know, we don't have a lot of upside theoretically other than the coupon and then some downside. So we're looking for companies that have sustainable cash flow, are not secularly challenged, you know, have a good business model, and the ability to service their obligations.
Yeah, I mean, sometimes high yield is high yield for a reason, right? I mean, the risk that you're taking on, and then of course, if you're concerned about repayment.
Experienced manager.
Right.
I mean, we all get paid to take risk, but I think to Dave's point, you don't want to take asymmetric downside risk. So we always try to avoid binary risk, right? Large customer concentrations, regulatory, commodity risks, things like that. You're just not getting paid for it, but we do lean into companies that have very recurring revenues, either contractual or sticky products and services, very diversified, to reduce the kind of all your eggs in one basket risk.
Yeah, and I think in the middle market, we still have the opportunity to have bilateral negotiations with companies. So you can really go in and understand the needs of the companies, what's causing the need for that particular financing. And they're getting more sophisticated too. They see the structured solutions that are out there, so they're starting to understand the lingo better as well. But you can really understand the positives of that business as well as some of the risks that they might face, and structure your solution in such a way that it works for both sides.
Yeah, and one of the advantages of being in the private debt market is we have a direct relationship with the borrower, and there's one or very few number of lenders. So if things don't go quite according to budget and the company needs some latitude on certain terms, we have the ability to adjust the contract and make sure that the company can get by hopefully a temporary hurdle. Now we can benefit, improve the economics if that's warranted and so forth, but you have that ability to modify the terms, which in a broadly syndicated loan or bond, it's more cumbersome.
Yeah. Has the SEC's approach to the classification of private debt over the past year, has that impacted how the market's been operating?
I mean, to some extent, but I think a lot of it is really just honest disclosure as to what the manager's doing so that the investors are buying what they think they're buying. I think that's the driving factor. As far as us lending money to a company, it really has minimal impact on that part.
Yeah, I would think the more disclosure and transparency, especially as the products have been growing, is a good thing, right? I mean, you don't want that setback in the space should things, because of non-transparent actions, whether intentional or not, certainly doesn't help the case for investing in a private credit product.
Right.
Agreed. Yes.
Yep.
So how do you see the space evolving? What are some of the trends that you're watching as you think about new product and new structures of deals and so forth? Right.
Yeah, so I think, like I said, there's a lot of different products coming to market in terms of the, solving the issue of longer duration and liquidity. I think we are already starting to see, though, I'd say in Q4, and it's ramped up a little bit more in Q1, a bit more M&A activity. I think existing companies have absorbed the heightened rate environment, kind of operating in a new normal, and so I think we're expecting there's going to be some adjustment to purchase multiples in order for the floodgates to open on M&A volume. But I think what we're going to see is increased activity in 2024. Nothing like we saw in 2021,
right.
But certainly more in the last 2 years.
Well, I mean, that valuation reset had to happen. It didn't make any sense. I mean, it was like growth at all costs, right? And you don't have any governance, the balance sheet is a mess. I mean, we kind of go through these cycles every 10, 15 years where we see, crazy valuations and just bringing, what the next trend is to market. But it feels as if, certainly in the public markets, which I can speak to, everyone's looking for AI right now. That's the big trend. I'm sure it's the same in the private space as well. But I feel as if investors are a little bit more cautious when it comes to assigning these kinds of multiples because, as we saw in the public space, some of these companies that came to market haven't seen their IPO price since. So I would argue managers are being more respectful of valuations.
Well, so it's interesting because we also, we don't just do credit secondaries, we do equity secondaries, and average durations are definitely longer. And so if you're a buyout manager, you have all this embedded value stuck in your funds. You need to sell, or you need to take an NAV loan, you need to do other things to get liquidity to your investors. So you can only buy so much time before you need to return that capital. But sometimes waiting helps, because even if your multiple's coming down, the company can grow into it. So I think that's one of the things will help stimulate more liquidity is maybe you've held a company for 1 or 2 years longer than you wanted to because it was overvalued, but if it's grown into its valuation, then you can exit and still get a decent return on it, but it just takes a bit longer.
And we've actually seen a lot of our activity the last year and a half has been follow-on investments in existing portfolio companies. You know, to Ed's point, they're not ready to sell yet, and so they're going to continue their M&A strategy, cost average their multiple downs, where they can actually afford a slightly lower exit multiple.
Right. And that's sort of what we saw, that's kind of what we saw come out of this last valuation reset. I mean, like to my point before about balance sheets and governance and structuring management in a way that offers more longevity. It's a good thing at the end of the day from a fundamental perspective.
I think it provides more stability, and I think as the private credit area grows as an asset class, you are seeing new investors come in, right? So people who want to do NAV loans or secondaries. So there's kind of a space for everybody in terms of where they want to play, and I think that's a positive of the growth, that you could have a diversified portfolio within private credit, coming into a seasoned portfolio through a secondary, and then going into more of a blind pool type of fund to get access to a different part of the market.
Are there more sectors or areas of private credit that are more attractive than others? Is it like that in the equity space where, okay, I like healthcare, I like industrials. Is it like that in private credit as well?
I mean, from our perspective, we want to avoid the more obvious pitfalls. So as was already said, we avoid lending money to companies that are dependent on a volatile commodity, like oil and gas exploration. These companies don't make sense to have a lot of leverage. It should be more equity finance. And secularly challenged companies and so forth. So we avoid certain sectors, E&P, challenged markets, telecom, certain segments of telecom, movie theaters, companies like that where the cash flows could be challenged.
Well, I mean, the cost of capital is so much more expensive than it was before, and then they're also capital-intensive businesses.
And I think you often see that people develop, or investment managers, they develop specialties, right? So you know a certain sector really well, and you have deep domain expertise, and you have a network around that. So when you are in that particular credit working with that company, you're bringing more than just the capital to the table for them to help them grow and expand, and then hopefully get paid back at the end.
So I was thinking if you had an ARR-based lender here, they would tell you that software is a fantastic credit risk. But if you had an asset-based lender here, they'd tell you that's crazy. So there definitely is specialization. Like, you really need to understand the niche that you're in. And then I'd also say, like, the definition of what is senior, what is subordinate,
Well, it's subjective.
It gets murky to a point, right? Because you might say, I only do senior lending, but you're doing a bunch of second lien, or like a junior first lien. And so, there's also specialization within, where you're in the capital structure. But I think if you're an investor looking at all these different strategies, it also can be very confusing to figure, okay, how do I compare these two? Because they might have the same thing on the tin, but like, what am I actually investing in? So, by the same token, how big is the market, right? You look at Preqin, which is a source we all look at, it says 1.5 trillion. Like, we think it's 3. If you talk to other people, they think it's 5. So it's really like, what is the product? I think as the market evolves, the definition will get a bit more clear, I think, over time. But right now, it's pretty wide open, and there's room for a lot of people to play different spaces.
And I would say also, like, the market is segmented not only by company size, and it's getting down to very specific segmentations, right? Less than 2 of EBITDA, 2 to 5, 5 to 10. Like, people are finding their roles, but all of us sitting around the table invest in private credit. We don't really cross paths too much. We're in our own little corners, and so I think it shows the maturity level, the sophistication, the efficiency that private markets have in today's market.
All right, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.